Good morning, Prasan Bhai. Sorry about the small problem here. So should we start?
Have everyone else joined the group?
Yeah, I think there is Narsimhan and there's Mr. Nanda.
Sure.
Okay. So I think with that, welcome participants. Welcome to the FY22 earnings call of Elecon Engineering Limited. We have the top management of Elecon, represented by Mr. Prasan Patel, Mr. Nanda, who takes care of the care division, and Mr. Narsimhan, who is the CFO. We will start the proceedings with a brief overview of the quarter given by Mr. Patel, and then we'll go to the Q&A session.
Well, thank you. Good morning to all of you. It's a great day today, especially for India, because yesterday the Olympics has just ended and India has got the highest number of medal tallies. So this is the first time that we have won so many medals, and we are also very proud that we've received the gold in javelin. Apart from that, it is also a great day for Elecon today. And the reason is that if you see behind me, there is a huge gearbox, which is the gearbox which has gone into the first aircraft carrier that India has produced on their own in India, in Cochin shipyard. And the sea trials are going on, and our gearbox, the main propulsion drive of this Vikrant, INS Vikrant, has been supplied by us, and it has been doing extremely well. The results have been extremely good. This is also the first time that any gearbox in the first trial without any hitch has performed so smoothly and excellently, without even doing any minor tweaking. So it's also a very proud moment for India that our own indigenous aircraft carrier, INS Vikrant, has started floating, have been started doing trials, and you should be proud that our company has supplied the main propulsion drive. So it's a great honor and a great privilege. So thank you for being part of this, because we at Elecon are extremely excited and thrilled about it, that we were able to contribute so positively towards the welfare of our nation. So it's a big and proud moment. The presentation for the first quarter results and the description and analysis has been posted on our website, which has been done just 2 hours ago. So I would request you to visit our website and have a look at it. It gives you all the information that you require. With this, I would be ready to take in any questions that you have, because the statistics are all known to you. I don't need to repeat. So with this, I'm ready for a question and answer session.
Anyone who has a question can press your raise hand button, and then we'll open up for Q&A. Yeah, the first question is from the line of Zaki Nazir. Zaki, I've unmuted you. Please go ahead.
Prasan Bhai, good morning, and I think congratulations to you and your team on such a fabulous first quarter performance, and more so because of the gearbox for our defense ship. I mean, it's a great achievement, sir.
Thank you. Thank you.
Prasan Bhai, during the previous, I think the quarter ended December results. Although the indications for Elecon turnaround were present, you were maybe 75% confident that the year ahead will be great. But since the March quarter and consequently the fantastic June quarter results, do you think Elecon has taken on another path and will regain its lost glory? And also, sir, you were mentioning about the material handling division, about something you would want to do in terms of restructuring that. So what about that, sir? Thank you.
Sure. Thank you. I would also like to mention out here that the gearbox that we have supplied for INS Vikrant is the type where very few countries in the world can produce such kind of gearboxes. And out of which there are hardly 5 or 6 companies in the world who can produce these kind of gearboxes. And I can proudly say that we are the only one in India and among the top 5 in the world who can do this. So that also is a big achievement. Coming to your questions, December, you said that I was 70-75% confident. I always believe in being a bit conservative. While we were expecting that the gear results would be good, there were still some corrections that were necessary for material handling to reach the level of performance that we were looking for. Okay, because it was a vast amount of restructuring that we had to do, because we had to shrink the organization from an organization which once upon a time was doing almost 700 crores down to 150 crores. Plus, we had to organize ourselves in a very different manner, because the kind of business that we were doing, which was more of contracting and projects, was now transformed into product sales exclusively. So that was also a big shift, repositioning the manpower, doing a lot of changes. So all that was happening. And till it was not finished, I did not want to give you any wrong indications. Now that has been done, and we are able to see light at the end of the tunnel. And apart from that, the gear has always been performing good, but now it has reached a situation where we are very confident that even our foreign offices are going to contribute in a big way to more exports. The domestic after-sales service business is also healthy, as well as our new business, which new orders that we get are also with reasonably good margins. So going forward, we are very confident that the year will go quite well as we see a good future.
So about the material handling division. Sir.
Yes, material handling, as I told you, the orders which we had taken earlier, the project orders, out of which the 2 NTPC jobs, which were the ones which were causing us a lot of anxiety, they are right now almost 98 to 99% complete. Okay. There is final tweaking that is happening at site, and we are reasonably confident that by 30th of September, even if it stretches beyond, maybe 30th of October, we will be signing the documents with NTPC and exiting those 2 projects. So if that happens, then majority of our bleeding would stop. okay, as well as the other projects which are going on. We have a big program of closing those sites and getting out of it. A lot of it has already been done, and we are reasonably confident that this year the losses from material handling would almost come down to 0.
That is fantastic, sir. And sir, our debt level last year end was around 300 crores. With the retention money coming back and all that, I mean, what expectations would you have by the end of the current financial year? That is March 22. 20 years.
See, first of all, there are two things that we are doing about the debt. While we are trying to reduce the debt, on the other hand, we are trying to refinance our debt so that we bring down the cost of interest on the debt that we have. And I am reasonably confident that we will be able to save a few crores of rupees in refinancing the debt, as well as there is a continuous endeavor to keep on reducing the debt as far as possible. Okay, if you look at the history, you will find that on a continuous basis, we have been reducing debt. And now with the healthy financial situation that we have and profits increasing, that would be also further accelerated.
Fantastic, sir. And best wishes for Team Elecon, sir. Thank you, sir.
Thank you. Thank you so much. Exactly.
Thank you, Zaki. The next question is from Manan Shah.
Yeah, hi, sir. Congratulations on a good set of numbers and congratulations on the successful delivery to the Indian Navy. I'm fairly new to the company, so pardon if my questions are a little bit rudimentary.
Not at all. Feel free.
Yeah. Sir, so I was just looking at our numbers. So first on the gear division. So in the past decade, our gear division, we have not been able to clock revenues higher of 900 crores, right? And in the previous call also, you indicated that we are operating at around 50-55% utilization. So if you can just throw some light on what, and currently we have some around 417 crores worth of orders in the gear division. So if you can just throw some light of where are we looking on scaling this division, like, and what kind of revenue can our current facilities generate? So is it possible to reach 100% kind of utilization or 90% kind of utilization practically, or 70 to 80% kind of utilization would be a peak utilization that we can generate? And what sort of order pipeline do we have, since we cater to most of the core sectors and we are already seeing those sectors announcing huge capexes. So if you can just throw some light on that, that would be great, sir.
Yeah, Manan, I would put it this way, that we had installed these capacities during the time that India was going through a big boom. So thinking optimistically, we thought that if we install these capacities, we would get a head start and would perform quite well. On the other hand, after that came in the recession, and then the utilization decreased to almost 40%. Okay. The company took a lot of measures to reduce the operational costs so that even with 40%, we were able to break even and generate margins. Later on, as now what we stand is that the investments that were made for additional capacities, they have depreciated. Apart from this, we are seeing that the increase in demand is coming from exports, where the margins are healthier than what you find in the domestic business. There is the after sales, or I would say the customer service and after sales, which is also showing a very healthy, demand. Because we have gear units which are almost now 30, 40, 20 years old. Okay. So those are coming in for repairs and for replacement of parts and things like that. And then the new orders that we are taking, we have made sure that the payment terms, the terms and conditions and the margins are kept to a reasonably healthy level. So all this has seen to it that the upsurge in profit continues, and we are reasonably confident that this would continue. Now, as long as capacity utilization is concerned, normally, Manan, if we are able to achieve 80 to 85% capacity, that, according to me, would be reasonably healthy. The reason being that, ideally speaking, you can go to 100% or let's say 95%, but because for that you would require an ideal product mix, which never is practically possible, because you get variety of orders of different types and sizes, and therefore I would put it as 85% would be the maximum that you could do practically.
Okay. And on the bid pipeline for orders, like what sort of order book would we build up going down the line? Because earlier you mentioned that our orders are generally executed in 3 to 4 months, right? So the current order book would also be executable over the same similar kind of a time frame. And what kind of order book are we looking to build up over the next few months?
See, normally our order execution cycle, if they are standard gearboxes, catalog gearboxes, they are about 6 weeks, which is 1.5 months. And if they are custom built, it could be almost 6 months. Now, the order book that we have as of now, we have to understand the figures that we have given you are including the Navy order. Now, that Navy order, if you deduct, the orders are reasonably healthy to keep our rotation going strong. And that is exactly what you need. You do not want excess order booking, because today the steel prices are fluctuating, and therefore you would like to have just enough orders to keep your wheels turning in a robust manner.
Then coming to the material handling division, as you mentioned, we've scaled down that business significantly, and so we have idle assets over there. So and now we are planning to be more of a product company than a EPC kind of a company.
Sure.
So what is the plan? Have we decided on any plan of action on that division? What kind of top line are we planning in that division? So if you can just highlight on that. And then lastly, from my side, now as we're expecting these 2 NTPC projects getting over, so what kind of release are you expecting from the receivables?
The receivables are showing an improvement on a continuous basis. There are internal targets that have been laid out for receivables, but it is very difficult to actually ascertain as to what would be recoverable, because quite often the customer does not maintain the timelines. So though you may receive the amounts, quite often there is a good amount of delay in getting those receivables. So, but we are trying to continuously put pressure on the clients so that we keep on getting money, and quite often it also trickles down, which means instead of getting the entire amount, you get it in bits and pieces. But we are on it, and we are reasonably confident that this year also we will be collecting goods and large sums of money. On the other hand, let me tell you, as long as the utilization of assets of material handling are concerned, right now majority of them are lying idle. We are looking at various businesses that we can adopt, so that we can diversify into product lines which would be either in the construction business or into other heavy mechanical engineering areas where we can utilize our facilities and increase our turnover further. But conservatively speaking, I would say that is at least 6 to 12 months away. Because by the time you select what you want to go into and mobilize yourself into that business, it would take some time.
Okay. Thank you. I'll get back in the queue.
Thank you, Manan.
Thank you.
And it's from Abhishek.
Hello, can you hear me, sir?
Yes, we can hear you clearly, Abhishek.
Yeah, I'm Nilesh here, sir. How are you? Very, very nice to see a lot of happiness on your face compared to what we spoke a year and a half ago, sir.
Well, you know that COVID gives you a lot of tension.
Yeah. Sir, my question is one on this Navy gearboxes. So after having gone through this experience, have we developed capability to design these gearboxes, or we are still not at that stage?
That's a very good question. I would explain it to you a bit differently. Indian Navy has requirements for gearboxes of all kinds. They are extremely simple gearboxes, then a bit complicated, and then most complicated. Let's say we are at step number 2. We can design and execute easily the simple and the reasonably complicated gearboxes. But the most complicated ones are extremely tricky. And for that, we have yet to develop the kind of experience that is required. But I'm sure that over a period of time, we will be able to do that. On the other hand, let me tell you one thing, that the problem is that we have not enough orders whereby we can develop that expertise to the level that we would require. But as I told you, that over a period of time, we would gain more and more experience, and then we should be able to do so.
Sir, second is on the, you mentioned that you are seeing a lot of signs of development and probably inquiries on the export area. And we have been seeding this US market, particularly for last more than 5-6 years. So can you please help us in more detail exactly at what stage we are, how are we seeing the inquiries coming in, from what sectors in US, and how do we see especially the US market over the next 3 years in terms of, because I think that's a very large market as you had explained once.
Right.
How do we see ourselves over the next 3 years in terms of some kind of a ballpark revenue thinking?
Let me put it this way, that US is the most promising market because it is extremely large. Okay, right now we don't even have 0.1% of the market share. We are just exploring the area and territory. But what is important is that we have started getting breakthrough from reasonably good customers, important customers, not only in the US, but US also has a windfall coming in from South America, which means that the South Americans order gearboxes in United States, okay, especially the large and heavy ones. And we had opportunity to serve Chile. We've had opportunity to serve Peru as well as Colombia. So we've got breakthroughs out there, and they are also reasonably happy with the performance of our gear units. Apart from that, we've got breakthrough in United States in various fields like cement, rubber, steel. So we are hopeful that because in United States, as you know, the type of industries that are existing out there are varied and many. So I would say the opportunity is fairly large. What we did about 3 years ago is our best marketing and application engineering person. We shifted him out there to the United States, and together with his help, we rebuilt our entire marketing structure out there and started approaching clients with our application engineering and experience and references, and that has started paying dividends. And over a period of time, we are seeing a growth of almost 20-25% every year, year on year, as long as our products are concerned. And we are hopeful that this will continue going further.
So how do we take care of spares and services in these kind of markets?
We have a setup out there. We have an assembly unit out there. So we bring in these gear units back out there. And then whatever needs to be replaced, those parts are sent from here and then replaced. And if they are required urgently, they are, sent by air. So they get them very fast and then they are replaced.
So coming back to the Indian market, what kind of growth are we seeing in the gear business on a year-on-year basis? Excluding if we exclude the Navy business?
See, as I told you, we were scared when COVID came in because, we were worried that the market may completely slump. That luckily did not happen. And we have seen that in the last years, at least a growth of 8 to 10% is on a continuous basis. We are seeing a growth of that kind. And we are hopeful that at least that should continue.
Okay, sir. Thanks a lot. I'll get back to you in the queue again if I have more questions.
Definitely.
Thank you, Abhishek.
Thank you.
This question is from Ankit.
Hello, am I audible?
Yes, you are, Ankit.
Yeah. Good morning, sir. So my first question is again on the gear business. As you just mentioned that 8 to 10% kind of a growth is visible for you in the coming years on a consistent basis. But you also mentioned that your current utilization levels are around 50-55%, and the peak can go to 85%. So, once you reach to those levels, what kind of margins can we see in the gear business at the EBIT level? I mean, last year we did some 21.6% at EBIT level. So with operating leverage coming in, what is the scalability in margins in this division?
Ankit, it is difficult for me to tell you that because it will depend on the product mix. But what you can take it as a certainty is that they will go through a substantial jump because our fixed costs are quite high. And once they are covered, the margins would keep on continuously increasing. Okay. But it will all depend on the product mix.
Okay. But is there a possibility of like going to 25-30% also?
Oh, yes, for sure.
Okay. And so my second question is on your MHE division. So you did mention that, from now onwards, you are not taking any EPC orders, but the product business will continue. So what could be the run rate of that product business on an annualized basis? I mean, would it be like 200, 300 crores? And on that base, what could be the margins at EBIT level?
See, Ankit, right now we are targeting anywhere between 130 to 200 crores as the turnover of material handling division. Okay. Now, out of which a sizable amount is the after sales business and the rest would be product sales. Now here also we are being very picky because unless we get the desired margin levels, our payment terms, okay, we do not want to sell products and create losses for the organization or have a negative cash flow. So considering all that, we are going very conservatively. We have fine-tuned the organization for that kind of turnover. And we believe that if we are able to do this over a period of time, you would be able to generate at least 15% to 20% at the EBITDA.
Okay. And so my other question is on your, again, gear business. Who are your main customers, sir, in India? I mean, any particular corporates which form majority of the revenue?
I would say, Ankit, you would be proud to hear that almost everyone in the who's who list would be our customers. Because since the gears go into various kinds of industries, all the big names are definitely having at least a few gearboxes of ours.
Okay. So who is your main competitor?
Our main competitor, because we have a very wide product range, for every product line there are different competitors. Okay, but I would say, generally speaking, for the big gears, we have a Flender, which is a German company. Then we have Premium Gears, and we have Shanti, and we have New Allen.
Okay, so the German player and Premium, all those have facilities in India, or they
yes, they all manufactured in India. The German company manufactures majority of them in India, but there are a lot of products where they also import and assemble out here and partially manufacture out here.
So what would be your market share, sir, in the addressable opportunity in the gear business?
Generally speaking, our market share is approximately around about 30%. But we are the largest in size, and our nearest competitor would be almost 60% our size.
Okay. And so my last question is, you did mention about the growth in the gear business. So this a 10% growth you are expecting only in the India business or for the company as a whole, including the exports one?
10% is 8. I would say 8 to 10% would be in India. And the export business, which today is, if you look at the total business, it is not substantially large. There we are expecting even a higher growth rate than that.
So any ballpark idea for the company as a whole in the gear business, what kind of growth you are looking at, including the exports one, for the next couple of years?
Let's put it this way, that if we are able to do 15%, we would be reasonably happy.
Okay. That's helpful, sir. Thank you so much.
Thank you.
Thank you, Ankit. The next question is from Karthi. Karthi, I have unmuted your line. You can unmute.
Yeah. Good morning, sir. Thanks for the opportunity. Can you talk about the pricing environment? I see that your, the steel component or metal component has gone up in terms of your input costs. So can you talk about the pricing environment, and do you see that, how are you able to correct it? Some thoughts on that.
See, because we have a short cycle of execution. So we have been very cautious because the steel prices have been increasing to a considerable level suddenly. So all the new quotes that would go in would be at new prices considering the present price scenario. So because they are, as I told you, our product cycle at an average varies from 6 months to 6 weeks. That is 1.5 months. So all the new bids would be going at new prices. and therefore we are, I would say, very microscopically affected by increases.
Right. Would you also be able to share with us the split of your order book in terms of standard and custom products on an ongoing basis? Because that would help us understand how the business is evolving.
Mr. Nanda, would you be able to tell us how much is the
around 60%. 60% is the catalog product and 40% would be engineered products. Sir.
Right. So would there be any inventory gains on the standard product size, sir? I'm asking this because, or do you start making it after the order is received? How exactly does that work?
Normally we stock the raw material because they are round bars. Okay, which means rolled round bars, and then we cut them to size based on what we require. So we keep some material in stock. Okay, and then they are mass produced, especially the catalog products.
Sure. Thanks very much and best wishes, sir.
Thank you.
Thank you, Karthi. The next question is from Sunil. Sunil, you may go ahead.
Hi, thank you very much, sir. Question like, congratulations for such a good number.
Thank you, Sunil bhai, and nice to hear your voice.
Sir, looking at the language you spoke on initially, the way we supplied this propulsion gear to defense, I think we have so many this type of quality and capabilities. So if you would like to talk something on what exactly or what specifically capability and competitiveness we have in terms of local market, international market, the way we are penetrating US market, larger picture qualitatively, may not be quantitative, would be very helpful.
Okay, let me give you some background. First of all, the good thing about your company is that the fact is that we have one of the largest, or let's say the widest variety of products in our portfolio. If you look at, let's say, the smallest gear that we might be manufacturing might be 10,000-15,000 rupees, and the largest might be almost close to 100 crores. So the variety of products that we manufacture are very, very large. Okay. Practically, I would say the largest gearbox manufacturer in the world, they have this kind of variety, and ours is even larger than that. So what we have is, these are products which are all active, which means that it's not only on paper, we are selling them, and in India, probably in all our products that we sell, barring one or two, we have the largest market share. Okay. Apart from this, I would say that we have a very, very strong and robust engineering team, which is able to develop new products, are able to improvise on product lines that we have, and so forth. We have the capabilities. Let's say, if you talk about last 5 years, the cement and vertical cement mills and vertical coal mills were being imported from Germany and from Europe, which we are the only company in India who's producing that now. And we have been able to successfully deliver a lot of them to our customers out here. And today, our competitor in this field is Flender. They are partially importing products, components, and then assembling and then selling out here, while we completely manufacture the entire unit out here and we sell them. Apart from receiving this technology by a license arrangement from REC, we have further developed this, enhanced the series to larger size units, and also made sure that we are able to optimally design them and improve the performance by reducing our manufacturing cost. So those are the kind of things where we are also an expert in. Apart from this, because we had an R&D center and the government had given us a lot of advantages in having an R&D center, we went ahead and developed a lot of series of catalog gearboxes where we were finding it difficult to compete with the big giants world over. So we redesigned our units, made them very competitive, and now we are getting a lot of orders from those kind of gears also. So those are also large and complicated gears. Similarly, in the sugar field, we've been competing with premium gears for our sugar planetary gearboxes, where our processes are far more sophisticated and better than our competitors. And we are able to, this is the third or fourth generation of redesigning that we took because the environment was very competitive. And we redesigned them to make them more economical, and still the performance would not deteriorate. But we did all this because we had the capability to do that, while our competition does not have that kind of expertise. So these are the kind of specialities that we have going forward. I mean, I can go on and on, Sunil, but I can tell you very proudly that we are one Indian company who are fighting shoulder to shoulder with all the foreign companies, and we have far more capabilities than most of them.
Great, sir. So I'm very hopeful, and looking at your the way you are saying, with all this capability, I think we'll be able to compete and beat in international stuff also. So,
oh yes, we are doing so even right now, and quite often, when we meet some of the American clients, they are taken aback that you have so much of capability.
So, sir, will it require any additional things? I think since last 3-5 years, we started doing everything as an investor we know. So, any additional things we required to do to penetrate very heavily in US or international market? Or we already planned everything or done?
See, Sunil bhai, we have been benchmarking ourselves with the best of the best in the world. So all the equipments which are required, we have not compromised anywhere in buying the best equipment and installing them and seeing to it that our boys who are on the shop floor have been trained to utilize this equipment very thoroughly. Now, the question remains that, yes, you will always have something or the other that you require to add on slightly to be perfect for the requirements of export, which we keep on doing to a minor extent. But I don't think that would vary, or the requirement would not be more than 10 to 15 crores on an annualized basis. That is also on the higher side.
Great, sir. I think you, your team, Mr. Narasimhan, the way we are managing now financial also, we are on a really good wicket. Thanks a lot and wish you good luck, sir.
Thank you.
Thank you, Sunil. The next question is from Rahul Dhruv. Rahul, you may go ahead. I have unmuted your line.
Yeah, can you hear me now?
Yes. Yes,
yeah,
sir.
Congratulations, Mr. Patel. I think it's a fantastic show again. Just wanted to check with you on 2 or 3 things. One was the retention money that you'd mentioned last time around of around 250 crores, which is lying with, I think in the material handling business. What is the status on that? When do we think we can get a major part of it or all of it?
Narasimhan, would you like to answer that?
Yes. Yeah, Mr. Rahul, as what we have indicated, the retention money is predominantly depending upon the completion of the activities and handing over the projects. That is when this retention money will be returned back to us. In the past, at least 9 months or so, we have been able to close around 3 to 4 projects. And though they were not as big as what is going to come in next 1 or 2 months, as what the CMD has indicated. Based on the projects which we have completed, we were able to collect the retention money. At the same time, in the next 6 months, based on the projects which will be completed, we will be able to claim those retention money. So that is the outlook on the retention.
Narasimhan, it would be better if you can give some kind of indication as to what is approximately expected this year.
This year, at least around going forward, we expect around 25 crores to be received this year. And once the balance projects gets completed, next year we should be able to project even further.
So sorry, so 250 crores, out of which you will receive only 25 crores this year.
Yeah, based on the projects which has been completed. Like what CMD had indicated that in the next 6 months also there is quite a lot of projects which gets completed. So that is, it is not 25 crores does not factor in that. So based on that projects completed, it is 25 crores.
Okay. My next question was on sir on the working cap. Sorry, on the cash flow. I think we're looking at an operating cash flow of around 200 crores. And of course, as you mentioned, that you're working pretty hard to reduce the working capital days as well. So we are looking at anything more than 200 crores. Wouldn't that basically mean that we would be a debt-free company by the end of the year?
Yeah. What we are trying to do is that we are trying to reduce our debt, as well as we are also trying to reduce our debt towards our suppliers, subcontractors, and various other stakeholders. So we have to balance between both these things. So our efforts will be on both sides. So what are the cash flows which you see will go towards reduction of the debt as well as the debt towards the suppliers and other people.
Just going back to your earlier mention of the material handling business being used or equipment being used for, or the plant being used for other things. And you mentioned mechanical engineering and construction. Could you give a little bit more idea to us as to what exactly are we looking at, what kind of products, and you mentioned 6 months. So I mean, would it be that easy to really start a totally different product line?
Rahul.
Yeah.
Right now, we have very large and heavy general machining equipment available with us. Okay. Which can be used in any type of industry. What we see right now is that road building and bridges and those kind of activities are today booming because the entire nation has got down to road building and construction. So we are exploring the possibility of manufacturing some heavy mechanical engineered products which go into that kind of industry. But still the survey is on, and hopefully if we can zero in on something, adopting and then starting it would not take much of time. There are also other lines that we are looking at. We have been approached by one German company to manufacture water pipes, develop a machine tool for manufacturing water pipes and so forth. So there are various opportunities that we are exploring. Right now, it is very difficult to say as to what would be selected by us It'll all depend on the kind of customers that you sell to, the kind of profitability that you are able to get from those products and so forth.
Okay, thank you so much. And just one last one. You mentioned in the material handling revenue of around 130 to 200 crores. Your current run rate is around 120, as in last quarter was around 30 crores. So I'm just checking what exactly are we looking at growth going forward? Because we had clearly mentioned last year that we will, bring it down quite a bit or shut it down and do only products which will basically result in a revenue decline and EBITDA or EBIT which is almost zero.
Yes. See, we have a sizable part of after sales business. Okay, which is 100 plus crores. Okay. So if you look at it, if I have to sell my products to meet my targets, I need to do only 30-40 crores, which should not be difficult at all. And this is because of the fact that we select the clients whom we are comfortable with, we select the payment terms, and if we do not get enough profitability, we are not interested in selling that product to the customer. And therefore, we have put a very conservative target. And therefore, I'm saying that it will vary from anywhere between 120, 130 to 200.
Okay, great. And you mentioned also that the interest cost, you will be able to save a couple of crores or a couple of crores because of the fact that you're renegotiating. And I see your average cost has been consistently going up, cost of debt. So what kind of a reduction can we expect? Because I see a lot of them are 2023 to 2024 maturity in the balance sheet.
I would say, Narasimhan, would you like to answer this?
Yeah. Rahul, generally, you know that the liquidity position in the market is quite good. And we also had to borrow at certain point of time, 2-3 years back at a higher cost. Now we are looking at the average debt of some of them were ranging between 12 to 13%. So those debts we are looking at around 8% to 9%.
Okay. There is some debentures also at 17%, if I am not wrong.
Yeah. So the debentures also we are refinancing this month. So that also, like as I say, effective rate would be around 8% also.
Beautiful. That's fantastic. Thank you so much.
Thank you.
Thank you, Rahul. Just a kind request, please restrict yourself to 2 questions per participants, please. There are others in the line, so please be wary of that. Next question comes from the line of Shubham Agarwal. Shubham, please go ahead.
Yeah, thank you for the opportunity, sir. Sir, firstly, I would try to understand the export business a bit better. So, given our total order book of 400 odd crores, what would be the total component of export business out of this? And typically in the export business, how do we see the margins compared to domestic? You mentioned that it is healthier, but how much percentage point extra that we get out of the export business? If you can help us understand a bit.
See, our exports is normally 1/3 of our business. Okay, you have to remove the Navy business from it, but at an average, it is 1/3 of our business. So let us presume it is 30%. Then 30% is our exports as a whole. Okay, and we want to increase it at least to 40-45%. Okay, over a period of time. Now, the margins normally in exports are, I would say, anywhere between 5 to 10% higher than what you would find in the domestic market.
Right. Thank you. And so secondly, on the after sales business, so both in the gear and MHE division, as you mentioned, that after sales forms a major part of the total sales. So I would like to understand how much of an after sales business is generated out of total 1 crore, let's say 1 crore of business that we do in gear division or MHE division. If you can help us understand that. And on continuing this question, like in MHE division, you said all the legacy order majority of the orders will be executed by September, and post that we'll be left with after sales and some of the product business. So do we expect positive margin from Q3 onwards, and if so, how much?
Our target this year is that if we are able to get to 0-0 level, as long as material handling is concerned, and pay an interest cost of almost 20 crores out of it, we would be happy. Okay, because you have to understand that MHE also has a debt which we have to service, which is sizable. So that is one aspect. The second aspect is that going forward, as long as gear business is concerned, they will continue to generate healthy margins. And therefore, the margins were getting reduced earlier because part of it was being absorbed by material handling, which once it stops, then all the margins that get generated from here are available to the company.
Right. Okay. And on the aftermarket part of the gear division, so generally how much of a business is generated out of that for every sales that we do in the gear division, and what is the typical margin in that?
I would say the maximum it generates is 15 to 20%.
Okay. Got it. And the margins?
Margins naturally, spares always have healthy margins.
Got it. Okay. Thank you. That's it from my side.
Thank you, Shubham. There were a couple of questions on the chat board, which I'll just read out to the management. This came from Shanti Devi. So the first question was, which are the critical factors which help Elecon to win projects against German premier companies, since they also manufacture in India, and to some level they're able to take advantage of low manufacturing cost in India. So they're not stated which company they're talking about, but basically what is the right to win for Elecon to win projects in India is what they're asking, I presume. So.
See, the good part is we have earned a reputation where our product and German product is considered to be equal, and there is no reason why they give any preference to the German product. Now that German product is also majority of the times is completely manufactured in India. Okay. In highly specialized cases, part of it comes from Germany and part of it is done out here, while we do 100% out here. The client normally gives you weightage for product which is 100% produced in India because of the fact that if he needs spares on an urgent basis, then we are able to provide them a lot faster than the competition. So that is one aspect. The second aspect is the client considers both of them equal. There is no preference given to the German product. And the client has been using our product in majority of the cases and have been fairly satisfied with us. And therefore, he doesn't give any additional weightage to the German company. As a matter of fact, because normally our deliveries are better than that of the Germans, because of our vast capability and manufacturing setup, and the fact that we have much larger resources than the German company, we are able to deliver the product much faster than the competition.
Thank you, Mr. Patel. I think there's a follow-on question which says, in exports, have you looked at some sort of distribution commission model in South America or developed countries? wherein the local player pitches a products and capability to customer, help in winning this business. This could give many profitable orders too, since local cost of manufacturing in South America shall be at least twice as a cost. So are we going with a partner-led model in South America is a question, I guess, given cost competitive advantages as far as Indian manufacturing is concerned. So,
see, as of now, we are operating through dealers and agents in South America. But going forward, we would, if possible, like to even tie up with domestic companies where we can supply part of the product, part of it would be localized. There would be an involvement, and therefore the client would get the product a lot more cheaper and competitive, and the after-sales service would be properly maintained.
I think that answers. We have a follow-on question from the line of Ankit Bagal. Ankit, go ahead.
Yeah, sir. Sir, a couple of things. So first is on your interest cost. So with majority of your interest cost expected to come below 10%, so on a debt of around 200 crores, will your absolute interest cost be around 20-25 crores going forward on an annualized basis?
Yeah, going forward, you're right. At around 10% cost of debt, we should look at 10% of the debt, approximately.
So the current interest cost of 50 crores will come down to 20-25 crores.
Yeah, correct.
Okay. And so second is, what is the unexecuted order book from Navy currently, and do you expect any repeat orders from the Navy going forward?
In Navy, there is a tendering process. Okay. So they invite bids from various parties and then they go. Now, as far as we are concerned, there are a good amount of projects coming forward, and we are in a position to, I would say, quote reasonably competitive prices. So the possibility of us getting orders in the future are reasonably high.
What is the current order book?
Right now, we are executing the project for 7 ship sets for stealth frigate battleships, which would get completed by the first quarter of next year.
Sir, in absolute amounts, I mean, how much worth of crores is your unexecuted order book from Navy?
Narasimhan, would you be able to answer that?
It's around 70 crores.
Okay. And sir, lastly, what is the working capital in your gear business in terms of receivables, inventory, and creditor days? Purely gear business.
It's around 3 months.
So 3 months is the net working capital?
Gross working capital.
So can you bifurcate in receivables, inventory, and what kind of credit you get?
Approximately on the receivable side, it ranges between 90 days or so, and on the payables, it is around 60 days. And then inventory, depending upon the type of inventory, it varies.
Okay. Thank you so much.
Thank you, Ankit. We'll take the last question on the line of Manan Shah, which is a follow-on question. Manan, please go ahead.
Yeah, hi. Thanks for the follow-up. Sir, my question was on the export side. So earlier you've mentioned that we had hired a decent team on the US side, but that team wasn't able to deliver. But over in the past call and today as well, you were sounding pretty positive on the exports front. So I just wanted to understand what kind of challenges that we were facing earlier, and what is the reason behind this bullishness for exports?
See, as I told you, I don't mind repeating it. I've said this in the past and I would again like to repeat that. When we initially started our operations in United States, we had put in people who were from this line of business, and we had appointed them from the competitors and put in an entire marketing team together. Because United States is a large country with 50 states, I mean, we had a lot of marketing people positioned in various states all over the country. They were unfortunately being monitored by a marketing head who was stationed in California. We tried doing this, which had a very high salary bill that we were spending on them, but it did not give us the desired results. Now we have dissolved that entire setup, and we have set up our own setup where we have our marketing people, the best marketing person, an application engineer, we deployed out there from India. And we relooked at the market, made various changes in how we sell so that we don't generate very high costs and are still competitive and are still able to meet with the reach that is required for such a large market. And that is what we have been able to do. And we have been starting getting good results.
Okay. Thank you. That was helpful.
Thank you.
Thank you. That was the last question. I would now like to hand over the call back to Mr. Prayasvin Patel for his closing comments. And I think for a couple of you who had some trouble logging in, apologies for the same. I'm really not too sure what happened, but we'll ensure that this doesn't happen in the future. Take responsibility for that. With that, Mr. Patel, closing comments.
Thank you. First of all, I would like to say that please go to our website and look at the presentation, which should answer most of the questions that even the people who have not been able to log in would be able to get the answers. Apart from this, if there is anything, you can even please email to us and we would be very happy to respond. The next thing I would say is that the first quarter has been very healthy. The performance has been extremely good. From what we are able to see through the eyeglass, I would say that the whole year performance is likely to be healthy because of the reasonable inflow of orders that we already have. And going forward, all our marketing team, nationally and internationally, are very, very positive. Considering the inquiries on hand and the possibilities, we feel that this year is definitely going to be one of the years which is going to be better than what we performed last year. And going forward, if we are able to maintain the momentum, which we are very confident of, the company is on the rise and it will continue to do so because the bleeding which was there in material handling has also going to be stopped, which is on the verge of stopping and is going to be stopped. So thank you very much for your sustained interest in Elecon. And we hope that we will see you once again in the next call. Thank you.
Thank you so much, members of the management and all the investors for logging in. And as Mr. Patel had said, in case you have any questions, you can either write to the company or Binay and I are also available. Please write to us and we'll kind of get back to you with any follow-on questions, comments or meetings. With that said, have a great Monday and a great week ahead. Bye for now.